Insuring your home is a wise thing to do, as it protects what is probably the largest purchase you will ever make in life. But many consumers risk being underinsured when they insure their home as the only considered market value of the property. Now we speak to Crystal Fourie, Director of MUA Insurance Acceptances. Crystal, thank you so much for joining us once again.
Thank you.
Great. Now, what is the difference between the market value and a replacement value? Is there any difference at all?
There's a big difference, and it's the fundamental mistake so many people make. Market value is the value that your estate agent would determine what to resell your property for.
Okay.
Where reinsurance or replacement value for insurance purposes is how much it'll cost to rebuild your property. So a major difference between the two calculations. And the market value would include the value of your land, where the replacement value of the building only includes the actual building that's built on the property.
So how important is it for an individual to have a proper valuation assessment of their property? What happens if you don't do that?
Kani, you said it's the biggest investment you'll ever make, and it really is for most people. Now, if you consider that if we have a building worth R1 million, and someone does their own replacement value assessments, and they determine that it's worth 500,000, and they only insure it for 500,000. If you have a claim, your insurance company will only pay you half of the claim because you only insured for half of the value, and that's what average or underinsurance is all about. So if you do an upfront valuation by an independent individual of your property, you can make sure that when that loss comes around, that you're not out of pocket to the tune of 2, 3, 400,000 or millions.
Okay, so what if you overvalue it? Then what happens there?
You can overvalue a property, and we find clients who overinsure their properties, and it's very important that you consider that as well.
Okay.
What's happened is with the property boom a few years ago, very expensive land translated into people thinking that their house is worth, say, 10 million. But the actual building on the property to replace is only 4 or 5 million.
Okay.
You won't get the premium back from your insurance company, and if you have a claim, they will still only pay you how much it will cost to replace that building. So there's no point in overinsuring. Insurance companies will only reinstate what you had before if you're adequately insured.
Now, why are luxury homeowners even more at risk of being underinsured?
Well, the bigger the value of the property, the bigger the potential exposure. So what we find is people don't think about the fact that to import, an imported MUA kitchen, the cupboards, and all the appliances, the appliances, actually form part of the building. So that they forget to include the 300,000 or 400,000 rand just for that. Imported tiles. You have to replace it with imported tiles again. Your insurance company will come and look at what you had before and determine how much it will cost to replace it. So subject to exchange rate, your imported items. So it's very important that you get someone to actually help you to do that valuation. It's not that expensive, but in the long run, if you have a claim, it's so worth investing a bit of money in a specialist to assist you with that rebuilding calculation.
Yeah, and it brings me to what I've just asked earlier on. Can an inaccurate valuation result in overinsurance if you obviously do it inappropriately?
Absolutely. You have overinsurance on buildings and on contents, and you just throw money into the water because you're paying premium on a risk that you won't get reimbursed for if you have a claim. So you have to get it right. But the biggest risk really is around underinsurance. Because if you think about a property worth 2 million rand, if you underinsure and you have a claim, you can lose on that investment 500,000, R1 million. We see it. We see claims come in where people are underinsured. I have an example right now. The client had a burglary. His value of his content is 1.5 million. The stolen items alone, 2 million, and he still has items left in his house. This means he's underinsured by millions. And that's when the grudge thing with insurance comes into play, because people say, I pay my premium, and when I have a claim that the insurance company doesn't pay me out. It's because they're not correctly insured. And there are companies like MUA out there who will assist you in having this valuation done. We actually pay for the valuation to be conducted. And then we take that average clause, that very onerous clause, out of the contract. And then you get paid your insurance ground up, no matter what happens to your claim. So it's important that you also look at your insurance contract to see what basis your cover is on.
Yeah, interesting. Now, your advice for consumers insuring their property?
First of all, it's good to talk to your insurance company if you're with a direct insurer, or talk to your broker. It is worth spending the money specifically on your building to get a professional to assist you, a quantity surveyor if you know one, a builder, or ask your insurance company to recommend an independent specialist to determine that valuation up front. And it's just so worth going through your policy and making sure that you understand everything before a claim happens. Because when your house burns down, and houses burn down, they do, or if you've got a flood damage claim like we've seen now, floods all over, then it's not the time to try and sort these problems out. Do it up front when everything's calm and collected. Make sure you've got everything in writing, and make sure that your insurance is in place and correct for the right value.
Great. Crystal, thank you so much for joining us.
It's a pleasure.
All right, that was Crystal Fourie, Director at MUA Insurance Acceptances.